Hey guys, so I appreciate some of the subscribers are probably a little bit new to Bitcoin and cryptocurrency, so I thought I'd do a sort of quick video on some of the key points. So when they say it's a decentralized peer-to-peer network, it's basically meaning there's no sort of single company or entity in charge of it. It's basically run by millions of people around the world. So miners create the Bitcoin itself, solving mathematical problems, and there's sort of millions of miners around the world. Although it's quite sort of centralized in China for the last few years. As they say, you can buy and sell on various exchanges. You hold it on a wallet, which I'll get into a little bit later. And yeah, cryptography secures the network, which is the mathematical problems that the miners are doing. So originally, the mining sort of started out by either sort of at the very beginning, it was people just on a laptop. It sort of evolved into people solving the mathematical problems with these sort of home rigs with graphics cards, and yeah, that sort of evolved. More people were, as the price went up, more people were wanting a piece of the pie, basically, and it's sort of, long story short, ended up as this sort of thing, essentially. Massive sort of basically data center type buildings with thousands of miners in. A lot of these, as I say, are in China, but new companies are sort of popping up around the world, wanting to sort of do this sort of thing in America and in some parts of Europe, basically places that you can get cheap electricity. So yeah, the lower your cost of electricity, basically, the more profit you'll make out of mining, because everyone's mining the same price coin. Um, but yeah, so this is the difficulty of the mathematical equations, basically. A lot of people seems to be a sort of bit of a myth that this is programmed to go up sort of continuously. That is actually wrong. The difficulty adjusts to however much power is on the network, basically. So as people develop more and more of these, trying to sort of take a piece of the pie, the difficulty adjusts upwards to suit. So as you can see, this is about a year's worth of the difficulty and hash rate. So the hash rate is how many computers are on the network, and so as you can see, it's gone up as more miners are coming online. But as you can see, sort of in March, a lot of people turned off their miners. So you can see the dark blue line went down, and shortly afterwards, so the difficulty is adjusted every 2 weeks. So you can see it's sort of up and down moves, and the difficulty came down to suit these people turning off their miners. So if a lot of people were to suddenly turn off their miners, the network doesn't collapse. It's just the difficulty would come down, and yeah, the network would be slightly less secure, but it would still carry on perfectly fine. So the supply side, you had from the beginning in 2009, there was 50 Bitcoin mined every 10 minutes. So that goes to the miners as a reward for solving the mathematical problems and sort of basically securing the network. So for the first sort of 3 years, there was 10 million Bitcoin mined, and then we had the first halving, and then you get 25 Bitcoin mined every 10 minutes. And then, so for the next 4 years, there was another 5 million mined, and it sort of continues halving every 4 years. So 2016 comes down to 12.5, and then May just gone, we now get for the next 4 years 6 Bitcoin mined every 10 minutes. And this is 6 Bitcoin divided amongst all of the miners in the world every 10 minutes. So the new supply basically is getting less and less over the years, and this will continue halving every 4 years for the next 120 years, projected to be about the year 2140, when it would all sort of the mining would end, but it is projected to, the network should still carry on beyond that, but we'll all be dead, so not too much worry about that. Yeah, so you'll end up with, as it keeps halving, getting less and less, you end up with 21 million basically in the end, although there'll be about sort of 20.5 million in the next sort of 10 years, so there really isn't a lot left to mine after the next sort of 10 or 20 years. So storing your Bitcoin, so you can buy and sell on an exchange. You could store it on the exchange like Coinbase or Binance, say. It's not really recommended because they can get hacked. Bitcoin itself has never been hacked, but exchanges is obviously down to their security software. So any company that has an online presence can get hacked. The same is true of online exchanges. Although Coinbase has never been hacked, you can never be sure. So most people recommend sort of taking it off the exchange, and you've sort of the couple of options would be a software wallet such as Exodus. So this is offline, it sits on your computer. You can hold sort of various different currencies, and you store it basically on your computer. You have a recovery phrase if anything were to happen to your computer, physical recovery phrase, so you then install it on a new computer and restore your backup, and everything's sort of back to normal. The other option would be a hardware wallet, probably for people with a little bit more Bitcoin or crypto. So these are about £50 or so, obviously completely offline. So you put them on here and you can take it anywhere with you. So people like the idea that it's sort of completely disconnected from the internet. Just gives you more sort of security, but if you're only buying small amounts, then probably £50, say, for one of these makes a little less sense. As far as the divisibility of it, yes, there's 21 million, but each one is divisible into 100 million. And so obviously there's plenty of supply to go around the world if it were to really take off. But obviously there's no, you're not affected by dilution or anything. It's essentially, if you had 21 million pizzas, somebody else can divide their pizza into a number of slices and sort of say sell a slice to lots of different people, but it doesn't affect yours because you still have a whole pizza. Sort of simplistic way of looking at it, but a lot of people get sort of confused about that when they see sort of buying fractions of a Bitcoin and other people sort of owning whole ones. And then you may have heard about forks and airdrops. So a few years ago, there was a bit of disagreement because obviously Bitcoin is open source. Lots of different people have their own opinions on how it should be developed and progressed. There was a disagreement, and this split into Bitcoin and Bitcoin Cash. So the way that works is they took a snapshot of the network, so everybody who owned all of their Bitcoin at the time. They basically copy that network, and everyone who owns a Bitcoin carries on the new chain, or carries on the existing chain of Bitcoin, and they also get the exact same amount of Bitcoin they have in Bitcoin Cash. And then both networks run at the same time. So this isn't real. Some people see this as sort of dilution. Obviously, you're doubling the existing supply, but realistically, within sort of a few months to a year or so, people decide which they like best, and Bitcoin Cash has sort of gained some traction, but never really gone anywhere. And Bitcoin, the original Bitcoin, still becomes the dominant coin, basically. And there's been lots of other forks of Bitcoin, so it's the same again. You just take a snapshot of Bitcoin. Everybody who owns Bitcoin then gets the equivalent amount of the new coin, and people basically want to try and sort of be the next Bitcoin. And you've also got airdrops, which are not a fork of Bitcoin. They are their own code, but they use the same sort of, generally the same snapshot idea. So they will say if you own 1 Bitcoin, then you'll get 10 of their new coin. But as I say, it's a little bit different to a fork in that they have their own, the new coins have their own code and their own sort of development. They're not the same as Bitcoin. They'll have different maximum supplies. It won't be 21 million. And yeah, they're just saying generally maybe they might have something they want you to do to get the airdrop, but a lot of the times they just say to people that own Bitcoin, you can have this airdrop. And yeah, some people sell off the coins and just put it into Bitcoin. Some people don't even know they've got it. So interesting way of sort of creating a new coin rather than just trying to start from scratch. And for the people that sort of make a criticism that it's only worth what somebody else is willing to pay for it, that is essentially the same as gold. Obviously, gold and Bitcoin don't have any income or earnings or anything to speak of. They are assets which you buy and expect somebody else is going to buy it for more than you if you want to make money on it. So gold has been around for thousands of years and essentially works on the same principle. Obviously gold is physically mined and Bitcoin is digitally mined. So a lot of similarities there, both fixed, or gold isn't fixed supply, but there's a lot out there and very little new gold is being mined compared to how much is out there. So that's why people like it. Whereas Bitcoin, there is sort of a small amount being mined compared to the existing supply, but it is fixed at 21 million, where gold obviously can be mined indefinitely as long as there is new supplies found. So just a brief sort of overview on sort of the key points, a lot of the sort of myths that you hear. So if you've got any queries, certainly leave them in the comments below. And likes always appreciated, and subscribe if you want to see more. See you soon.